good afternoon or good evening, depending on where you are around the world. Welcome. For those of you who are not sure where you are, just to make sure, we are the session. We are going to be talking today about how investors evaluate net zero commitments. I'm Suze McCormick. I'm a partner at a law firm of Morrison and Foerster. I think I was asked to shepherd this program because I've been focused on climate since about 2001. I became partner early in the last one of the first .com busts, and my husband had left tech and gotten very involved in the Presidio, the restoring the Presidio National Park, and I had the opportunity to meet some fabulous people who were very into sustainability and climate. And as I like to say, I took the red pill. And once I saw back in 2001 what was happening with climate, I became convinced that business was going to have to fundamentally change. And I am a corporate lawyer. And so since 2001, really, my main purpose in life has been trying to change the scaffolding, changing the governance, changing the mechanisms by which people either invest or operate their companies to make sure that they have either a positive impact or they mitigate the negative impact on climate and our natural environment. But you're not going to hear very much from me because we have an incredibly august panel. We have Amberjae Freeman, who is the CEO of Ethos Capital. We have Pooja Khosla, who is a vice president at Entelligent. And we have Westheim, who is vice president, sustainable finance at Goldman Sachs. And they are going to be sharing their views with you and their perspectives on how investors view the commitments, view climate, view carbon, view the commitments of companies to net zero. And if you've joined us today, it is likely that either you want to be a leader in the effort to combat climate change, or at the very least, you don't want to make it worse or to be viewed as making it worse. And you have recognized that your climate strategy is not just of great interest to your current shareholders, but also to new investors and to customers and suppliers and employees in the community in which you operate. Those of us who've been in this space for a while, this has been building for a long time, but we are right now sort of at an inflection point where people really care, and particularly investors really care. And your competitors, if you're at a company or if you're an asset manager, your competitors are talking about being carbon neutral, being net zero. Some of them may not know exactly what it means, and it can be risky and expensive if you don't have a full program in terms of how you're going to roll it out. So today we're going to be talking about really two elements of climate, from an investor perspective. One is evaluating emissions. Starting with emissions, 95% of emissions come from three sectors. All of you know that. If you're not in that sector, probably more focus on climate risk. But even for all businesses, folks are looking at how they can become carbon neutral, how they can become net zero. I think from an investor perspective, understanding the difference between carbon neutral and net zero, what your commitments are, how you're making those commitments is very important. But also from an investor perspective, how you're evaluating climate risk using TCFD and climate risk scenario analysis or other mechanisms to really make sure that your business can be resilient. So I'd like to turn it over to our panelists. And starting with Amberjae, introduce yourself and Ethos Capital and why, from an investment perspective, you guys are focused on climate change.
Absolutely. Thank you so much, Suze. My name is Amberjae Freeman. I'm from Los Angeles, California. That's where I'm currently, actually. It's funny you mentioned the Presidio, because when I lived in San Francisco for 7 years, that's where I used to live. Loved it. It's like the one thing about San Francisco I miss. In any case, I am chairperson and CEO of Ethos Capital. We are a climate-focused financial technology company. I say climate forward, although we do also consider social impact indicators with a special attention to principal adverse impacts, just because that's sort of my area of expertise. I've been in the sustainable impact ESG investing industry since 2007, so quite some time. And over that time, I've worked across asset classes and either as an analyst, developing methodologies and strategies, and also as a portfolio manager, building investment products. And the reason my firm is primarily focused on climate is because we see that alignment of the capital markets and all economic activity as a positive facilitator of achieving our social impact goals as well. So we're climate forward, but also focused on social and environmental impacts. And I'm really excited today to talk to you about how we think about and how we measure sustainability at all and achieve our net and figure out how to integrate net zero goals into portfolio construction. Thanks, Suze.
Great. Thanks, Amberjae. I've got it right now. Pooja, why don't you tell us a little bit about Entelligent and the work that you are doing related to climate there?
Sure. So I am Vice President at Intelligent for Product Development and Client Development. Intelligent is helping investors to measure climate risk. There is a lot of noise in the market, but there is not a GPS to guide investor on how they can measure risk, and what can be measured can be managed. So Intelligent was co-founded by Thomas Stoner and a Nobel laureate climate scientist, David Schimmel, who had a vision to translate climate models, forecast how the world is going to look like in a Paris 1.5 scenario, relative to a 2-degree scenario, relative to where we are currently living in, business as usual scenario. How much transitions are needed and how investment universe will be impacted by these transitions. What investment opportunities are ready, what are not, how we can translate all this and build in a packet which can be actionably used by investors, portfolio managers, RIA, and as Amberjae mentioned, markets, because when market has information, it can make right decisions.
Thanks so much. And Jared, why don't you talk a little bit about your role at Goldman in sustainable finance and how you guys are tackling and focused on climate.
Sure. So as Suze mentioned, I'm part of the Sustainable Finance Group at Goldman Sachs, which is located in the executive office here. And we were stood up about 2 years ago to begin to make good on our commitment that we made publicly to deploy or invest or lend and advise on $750 billion in capital related to sustainable finance. And what that really meant to us was thinking about our commitment as one that is oriented towards building the new economy that we're all facing, one that's thematically oriented. And so we identified 9 sub-themes and 2 macro themes that we think are going to drive the development of that new economy, one being inclusive growth, the other one being climate transition. And so a lot of the work I do for the group is really working cross-divisionally as a business partner with our investors in asset management, with our securities traders in global markets, with our bankers in our investment banking division, and even in-house with our risk division, to think about how do we actually measure climate risk, climate alignment, how do we advise investors, asset owners who are thinking about taking the next steps in terms of the journey, how do we think about engaging with corporates that are our clients and are trying to think about what they need to do in order to either decarbonize or meet alignment expectations that are being produced by the financial sector. So very much looking forward to talking to you today about some of the methods we're using, as well as what we're seeing emerging in this space.
Well, great. And why don't we start with Amberjae, and let's start delving into the question of how investors view the commitment. So, Amberjae, maybe we can start with when folks are aggregating capital through funds, through permanent asset vehicles, through other platforms, what are they telling their LPs, and what on the flip side are the LPs actually asking and looking for in terms of climate commitments from the asset managers?
Well, in the private equity space, it's a bit it's a bit different just because the investments are so direct. You're making direct investments into companies that have a specific perspective or specific focus. And so when I engage with private equity, LPs, GPs, et cetera, I'm usually looking at climate related industries and companies, and the metrics that we look at tend to be related to trying to understand either how they're avoiding emissions and or how they're reducing emissions, right? And it's funny you start with private equity because to my mind, private equity is where we need to have the most capital deployed in order to achieve our net zero objectives, simply because, to the points that I made to Jim way back when I first decided to participate in this conference, I said, a lot of the net zero commitments that have been made and that people are, talking about have very much to do with carbon offsets. And there's only, considering the level of emissions, there's only so much carbon that, we can offset, through planting trees or, other interventions. And so where capital really needs to be deployed is in trying to develop the newer technologies that will actually help us remove carbon from the atmosphere and help us, sort of offset in a much more holistic way, right, to avoid emissions altogether. But I think firms tend to, especially, companies are very short term in their thinking, and of course they have limited resources, and so they have to do what makes the most sense within a specific, time frame. And so the preference, or rather the capital has gone to, sort of offsets, but really needs to go toward avoidance. And the metrics that we use to assess that, right, of course, are how much carbon are you able to avoid based on, improvements in your operational processes, how much, what is the environmental impact of your products and or services that you provide overall, and then how are you reducing that over time, to meet certain, IPCC or other benchmarks. And so that's sort of how we look at it. But for my firm, what we do is we look at what a company is doing today, right? Especially in the public equity markets, we're saying, what are you doing today? And is what you're doing today actually in alignment with what, the universe of the possible? So forecasting, we do some forecasting, but really when it comes to building, and I'm moving from private equity, to public. In the public equity markets, we say, are you a climate leader today? And if so, then, but based on our criteria, then we will measure it. I'm not sure if that helps. And one thing I will say that's missing from most of the frameworks is, it's, the scope 3 emissions is still a very, very much a nice to have, not needs to have, but the scope 3 emissions are sort of the heart and soul of what we do at Ethos. And so because it's where 70 to 80% or more of a company's total supply chain emissions actually reside. And so there needs to be a lot of more attention paid to that particular aspect of capture. Anyway.
And scope 3 is difficult, right? I mean, scope 3 is the hard stuff, and for many companies, so scope 3 is really where the impact is, because
it requires transparency.
Yeah.
And
exactly.
There's a lot of opacity.
The example I give is, you have a large tech company that, is may have, it's bought renewable energy in for, all of its data centers, but is it looking at, the fact that its technology is being used by an oil major for oil exploration? And then, what do you do about that? At any rate,
I can take it further than that. Just I'll make it really quick. I'll leave it there. I mean, I'll make it really quick. You can take it further than that and say, what are the socio-environmental impacts of electric vehicles, which, is a huge something that we advocate for, right? And as sustainability-minded people. But honestly, when you're looking at nickel, lithium mining, copper, all of the things, right? It's really total supply chain transparency and emissions accounting is absolutely essential for achieving, or rather understanding and then improving, so that way we can then achieve our net zero goals 100%.
That's right. And I think I want to turn it over to Pooja. I mean, my simplistic, again, I'm just the corporate lawyer here, view of this is sort of, if you say you're going to be carbon neutral, then you can use offsets. And in fact, I'll even go further. A lot of our clients are actually using insets as well, sort of, so you may or may not have things that are verified. If you're going to net zero, exactly as Amberjae says, you got to be looking at how you're changing your operations, how you're actually, changing how you manufacture, how you do business, how you intersect with your suppliers to figure out how you can reduce the emissions associated with your operations. So Pooja, why don't you provide your perspective? You guys, I know, advise both asset managers, asset owners, all three, and companies themselves. How are investors in your world sort of evaluating, particularly on the company side, the net zero or carbon neutral statements made by companies?
So we are dealing with investors who are pretty much looking for vertical offsets and insets, that is within a particular sector, within a particular sustainability space, but also they're also looking into vertical accompanied by horizontal, that they want their investments to be across sectors, across regions, and pretty much they want power to choose leaders in these offsets and insets. And whatever impact we are going to see, we all know it's not going to be immediate. Like, things are not going to happen today. The commitments that we see for most of the developed markets or the public companies that are on the right traction are for 2030 or 2050. I like 2030 better than 2050, but 2030 looks unreal as well. And when we go beyond those developed markets and look into emerging markets, I don't think so that we'll see action applied that we want to see even till 2050. So they need information which is across vertical, horizontal, and pretty much in a time dimension where they can see the actions, both in terms of planet attainments as well as profits, not in 20, 30, 40 years, but in 2 years, 3 years, 5 years. So matching these goals like profits, planet, for people's betterments get tricky. And so that is what we look into to see what companies or what investments will be financially stable throughout these changes when we drive economies towards mitigation. What will be their resiliency, how the balance sheet indicators or profitability indicators of these companies will look like, not in 10, 20, 30 years, but starting next quarter, for up to 2 years, for more than 5 years, in the time dimensions where these investors are going to live, feel these changes. So pretty much, I know we all want to go to the same destination, net zero, but whether we are driving our car on a right road, we need a GPS to check in too. So we do somewhat kind of a GPS tech work over here.
To make sure that you're sort of minimizing the negative and maximizing as much as possible. And Jared, maybe turning to you, I was noticing in the chat there's a lot of discussion, and I know there's been a lot of discussion outside of the chat as well, as do you invest in the carbon removal, or are you also looking at avoidance that can yield offset? Give me your perspective. You guys again advise a large swath of investors who are focused in this area. How are they viewing the relative merits of both of these? They're kind of, we need both. I mean, everybody is like, it was way back when I was in this space, it's like, do we need solar or wind? Well, all of it, a lot of it, we need carbon removal, and we need avoidance projects. But I'd love to hear your perspective.
Yeah, so I think, we have a lot of conversations across our institution about what it means to be a net zero investor, what it means to be a net zero corporate. And the conversation differs a little bit by sector, but there's some common principles. And those principles are really setting and achieving carbon targets. And the rate of change for those carbon targets is really quite driven by climate scenarios, which can tell you a bit but have a lot of judgments associated with them about the appropriate rate of decarbonization by sector and how quickly you might be able to capture decarbonization opportunities. Then we also look at engagement from an investor standpoint. So these are factors like, is your company actually disclosing on climate? Do they actually make disclosures that demonstrate that there is a solid strategy in place for decarbonization? Are they demonstrating through their lobbying activity that they're aligned? So that's an increasingly important area for investors. And then the third area is investment in climate solutions. And this is where I think a lot of the removal, avoidance conversation comes in. There's certainly a lot of interesting removal technologies that are out there and nature-based solutions. We think about a variety of ways of accessing those solutions today. Many of them are quite early stage. So you'll see much of this actually in the private equity market or in the voluntary carbon markets, although the voluntary carbon markets for removal solutions are pretty shallow relative to avoidance solutions these days. But really the core responsibility is taking action within your four bounds as a corporate. Some of the offsetting activity that you might go outside and execute on, whether those are through contracted removals or contracted offsets, those are great things to have. They help to highlight the story and the unique capabilities and impact that you want to have often as a corporate. But one of the interesting things about this industry is that it tends to be very driven by how people actually measure climate alignment. Mm-hmm. And you go around and you start talking to data providers, you'll quickly find out that data providers are not capturing, for the most part, how much you're getting in terms of offset activity or removal activity, because there are currently gaps in the greenhouse gas protocol guidance that prevents that from actually being taken in a systematized manner from disclosures. So right now it's paid attention to, but often, especially for contractual allowances, it's a little bit left on the table in terms of how a company might be evaluated.
Understood. We do have one question, and those folks who have joined us for this session, please, I'm trying to follow the chat and the Q&A. I'm not sure I can do both, but I'll do my best. We had a good question, and you alluded to this, Pooja and Jared. Any of your views on sectors? So do investors evaluate or prioritize climate, obviously in the heavily emitting sectors, ag, transport, energy, or are they equally focused, on technology, on furniture? Again, going back to Amberjae's comment, also, really looking through to the scope 3, because we need all of it. How are investors evaluating, or are they evaluating differently by sector?
I can't speak for everybody else, but I can certainly say, Scott Case, you're 100% correct. Like, it's all about materiality. What is most material from an impact perspective, whether it's on climate or social impact, for that particular industry, sector, and even constituent, right? And then expanding it outside of just the constituent itself, but then looking at its total supply chain. Like, what percentage of its manufacturing processes are in X company, or X country? What are the, regulatory, social, environmental issues that are, germane to that country? Like, the granularity of data that's needed to really assess the impact speaks to what Jared was saying earlier about sort of the difficulty, right? Like, the granularity of data that's needed in order to truly measure impact is vast, which is why I think a lot of us have moved toward, trying to capture information and insights from both structured and unstructured data. The thing that I always say, and everyone, people might roll their eyes, is that sustainable investing, or even ESG investing, broadly defined, is a qualitative measure of risk that has quantitative implications. As such, a mixed methods approach to research is absolutely necessary. The quants aren't going to answer all the questions. Why? Because they need repeatable, repeatable information from a set of, data observable data, so that way they can make an assumption or an inference based on that information. But, you know, economics, I'm not going to get too, I'll keep it short. Economics as a discipline is first and foremost a social science concerned with the distribution and use of finite resources from a utilitarian perspective. Because we've quantified, or we tried to, you know, we say, you know, because we've moved away from that, we've lost sight of the holistic nature of what we're trying to do. But anyway, point is, yes, different sectors, look at different data, and then, you know, search for comparability across them to the best of your ability.
Yes,
I'll stop there.
I would just add on what Amberjae said beautifully, being an economist myself, that we really need to respect the diversity of sector and regions when we are speaking about the green growth moving forward. We cannot leave sectors or regions alone. It has to be just, it has to be inclusive. And when there are different people, different stakeholders, differences in sectors, differences in regions, we have to respect those differences. Maybe reduction standards may not be equal in all sectors. And how can they be equal? If we truly speak about numbers, 75% of GHG emissions is produced by less than 20% of the companies. Mm-hmm. So definitely we need to engage those so-called, I don't want to use the word dirty, but I would say less green companies, because the shade card of green is wider than what we think. Yeah. And everybody have to try and maximize the best. So we respect differences. We live in a world of monopolistic competition where there are choices, there are good choices. And this power of choice, along with regulatory standards, need a balanced mix so we can drive the balanced, just, inclusive growth all together, hand in hand.
That's a very good point. And going back to some of the questions, Gilfriend had a great study and a link to a study on benchmarking. Maybe Jared, for you, I'm always interested, you know, we're still in a world because we don't have consistency in terms of measurement and reporting, where people can say, you know, yes, I'm achieving my net zero goals and here's how I'm meeting. And it's very difficult if you're comparing one technology company with another technology company to really tell how they're doing. So talk to me, you answered the question, I think, about what data is missing, you know, and you responded on scope 3. I'm also interested in how you compare that data, right? You know, it's like, you know, if, yeah, and this will go to the next question I'm going to ask you, which is, you know, the focus on climate versus, you know, returns versus financial returns. You know, if, you know, for the money, for the investment in a given technology or in a given, you know, carbon removal, is it doing a good job or not? I mean, you can only do that if you're benchmarking against what other people are doing, for example, in carbon removal. And how do you get the data to do that benchmarking?
Yeah, so I think on specifically on the topic of measuring, evaluating, the place to start is really the investment universe that you're part of. So you're always going to be compared as a corporate to others that are in that peer group. For an investor will be, you know, whether you're a large cap company in the developed world, a mid cap company, you know, in the emerging markets space, that's going to be your set of peers. And it's going to be industry specific as well. Increasingly, you know, folks are thinking very much along the lines of how do I evaluate companies versus other peers within their sector in a smart way, in a way that actually takes into account some of the variations in real economic activity that build an on-ramp for decarbonization. Whether those are forward-looking climate solutions investment across, you know, your industry, or specific production-based activities that will give a leading indicator of actually where you're investing your strategy and your time and your product lines and revenue towards making a transition. Now, comparing companies in a consistent way across the sector or across an investment product can be challenging due to the variation in data. What we find is within scope 1 and scope 2, it's a bit better than scope 3 at the moment. Scope 3 gets challenging because not all scope 3 categories are created equal. As many of you know, there are 15 categories that go into the scope 3 guidance, and those are very different things in kind that have different materiality implications depending on what industry you're in. And the way that people tend to measure and report on some of these elements of carbon emissions does tend to be quite variable in nature. So what we're seeing is a little bit of a evolution here, where what we're beginning to do is really orient ourselves towards, 3, maybe 4 different sources of data that are out there that we try to use to evaluate companies consistently. I think often relying heavily on some nonprofit assessments in the alignment space, like 2 Degree Investing Initiative or SBTI or Transition Pathway Initiative. We look at emissions very often, we look at targets, and we look at production data. And then beyond that, we often look at stranded assets, management commitments and disclosures, and lobbying activity. And we may, look at other things depending on the sector-specific context.
Understood. And just drilling down on that, we had another good question from Adrian Steiner, and it goes back to something that Amberjae said, and Jared, you just reinforced, which is, to get down to scope 3, you need a lot of data. So how do you balance sort of the need for that data and that granular data and the cost associated with getting that kind of data and benchmarking? And Amberjae, maybe we go back to you as a first.
Sure, it's super funny that, okay, yes, I saw that question, and it's a great question. So the effort to gather the data, I think, is one of the reasons why so many people have moved, or so many firms have moved toward machine learning. And I know, okay, let me just say this really quickly about machine learning and what people call AI, right? So the term AI is bandied about a whole bunch. People use it as sort of like a way to validate or substantiate their process. But while the application of finding large data sets from a variety of different sources that are then distilled through various algorithmic, machine learning processes, the key piece, well, actually, I'm afraid to even say this. The key piece that we found is that what is that is still important is to make sure that you keep humans in the loop, right? And there's even a whole branch of machine learning called human in the loop machine learning, where you create training data for your machines to sort of run through and find significant indicators or softmax like relationships. But if you do not also then have that human element, and I mean subject matter expertise, right? And Pooja knows what I'm talking about because they got a bunch of such. We're all nerds, like Intelligent, Ethos, like we're nerds, none of us studied finance. We studied environmental science. I mean, we studied finance, of course, but environmental science, social sciences, machine learning, we're just you really need to have that subject matter expertise in order to be able to make sure that you're annotating that information correctly. And the cost to do that can be high in some respects, but it really depends on your methodology and how you approach it, and also how well and to what extent you are able to capture unstructured data and structured data from open sources. So I'll leave it there.
I would just add one thing.
Yeah, Pooja, go ahead.
I usually do. So I hear a lot of loudness in the market that there is so much data, incomplete data. I was reading the questions over here, how scope 3 is measured. There is a lot of reporting errors. There are a lot of biases. I just want to make sure that we understand, please do not let data rule you. You have to rule the data.
100%, 100%.
You have to create models, use cases of the data that match your vision and mission of sustainability.
It's so funny you say that, Pooja, because I've heard, I sometimes see the advertising like unbiased, objective, as if these are as if these are right and just, right? Like ways to think about your data. ESG investing and sustainable investing in general, uses objective information, but it does have a perspective when it's practiced appropriately, right?
Absolutely.
A perspective that is focused on achieving the objective, which is, of course, aligning our environment and our society, bring our environment and our society in alignment with our social and environmental realities, right? And so this whole notion of like, it's objective and it's purely quantitative and like, you know, removed from, you know, like humanity as a superior method of evaluation is a false, like, it's a false start. So, and it's not about data manipulation. Like she said, you know, don't let the data rule you, you rule the data. Just make sure that the inferences and the information or the insights that you're gathering from that information are based on sound principles. I'll stop.
Yeah. And I would take a step back, just to tell you, just to provide a little legal perspective. You know, the number of companies that make these commitments, net zero and carbon neutral, and then they call Jared or then they call Pooja. So you have marketing people because you want to keep up with the Joneses, right? You know, the FTC has the green guide. The SEC is at some point going to come out with regulations, but you've also got a lot of NGOs like Greenpeace who, you know, I love, but and others who are starting, you know, you make these statements, you make these commitments, and people are going to hold you to them. There is going to be a liability associated with not being able to support what you are doing, and there is liability associated with you know relying heavily on offsets and not having them verified, and so you got to be really thoughtful about, you know, not just, you know, being, you know, unwholly relying on data, but also making sure you're using it and then disclosing appropriately. Jared, I saw that you wanted to weigh in, and then I want to ask just a little question. We've been focused on emissions. I wanted to go back to climate risk for a second, but Jared, I think you wanted to weigh in there.
Yeah, I mean, I think, you know, in terms of Scope 3 emissions and the accuracy of that data, the state of disclosures is really not sufficient in most cases for us to confidently get behind that data and say that it's going to be usable and accurate within an investment process. And the reason for that is that companies have very different protocols in terms of how they disclose and what they disclose for Scope 3. Often that disclosure does not occur at a category level. And so a corporate may say, I'm going to disclose categories 1, 5, and 15, while another one does 2, 7, and 13, and they don't tell you that. So the challenge becomes that many of the disclosures are incomparable at the moment. And so to be able to integrate it well in the investment process, we do need a little bit of a sea change in terms of how Scope 3 data is reported, collected, and used by financial institutions. And a big part of that is actually building the data systems to make Scope 3 data collection tractable. So part of the problem is if you're a small cap company or you're a mid cap company or you're Walmart, how are you going to get all of the information on the footprint of every single one of your suppliers? Are they going to tell you that? How do you attribute that to the actual products that you're buying? How do you actually calculate, every vehicle mile traveled and pull that into your Scope 3? This is a massive data collection exercise that really shouldn't be underestimated for individual corporates. Things will get better over time because everybody's Scope 3 is somebody else's Scope 1 and 2. So that's, I think there's going to be a much more data-rich environment that we'll be able to navigate. But there are definitely major gaps in the disclosure universe. One thing we're doing as a financial institution is very early on, we got behind this group called OS Climate, which is intended to create open source data infrastructure for essentially emissions reporting, disclosures, and alignment and risk analysis. And the thesis behind that was that a lot of the data that is currently getting reported either goes out into the ether in a sustainability report that then is scraped by various data providers in a very error-prone way and not necessarily normalized, or it goes behind a wall. And that lack of transparency, especially on the base information that we're all making decisions off of, can really be a hindrance to progress. And so having reference tools and ability to actually gather this information in one place is a core part of our vision of how we see kind of this data universe unfolding and evolving over time, so that there can be a bit more openness and transparency, as well as clarity in terms of the standards against which all of you are being measured as corporates.
And the one thing I would just add from my perspective is I loved Amberjae's go with the geeks. I mean, there are people, one of the positive things about what's happening now is, 10 years ago, 5 people were talking to me about this. Now everybody's talking about that. So that's positive. The downside is there now, having been in this pool for a while, there were only a couple people swimming in the lane 10 years ago, and now everybody's in the pool and believes that they can help advise companies on how to do this well. And so there is, real risk and real opportunity. The other thing I would just note is if you take other places where corporates have had to change fundamentally, I would say FCPA and anti-corruption ahead of regulation. I would say cybersecurity. They were in a similar place on both of those a number of years ago. It's almost like sort of we've gone from preschool to kindergarten and data, and they'll be able to evaluate scope 3, but it's going to change. Now, as an investor, you can evaluate, the anti-corruption, anti-bribery. You can evaluate the sanctity and, make an investment decision based on, somebody's cybersecurity policies in a way you couldn't a couple years ago. So this is, I hope you guys will agree with me, this is an area which is ripe and will continue to evolve as the pressure from investors, but all over, is put on. So one question from all of you, is we've focused on emissions. Talk to me about an investor's ability to evaluate climate risk. You're sitting back looking at a company, looking at a fund. Pooja, maybe we'll start with you. How do you tell whether they're doing climate risk scenario analysis well? I mean, how do you know, how can you test sort of the veracity of their climate risk assessment?
So if you ask me, there are tools available in the market, but of course, yes. So if companies or investors are doing what they are saying, it should reflect in their balance sheet indicators. It should reflect in their price patterns. Like at Entelligent, we look into action-based approaches. Do we see companies less correlated with oil, coal, gas, and traditional fuels in current than what we have seen 5 years ago or 10 years ago? Do we see that these companies' balance sheets, revenues, cost are reflecting these changes? Even the slow movement here is a movement. We need a movement, and we have to track this movement. I know that everybody is hell-bound on carbon footprinting. I know it is very important to see where we are today, but it is equally important to know where these opportunities are going tomorrow, and 3 years ago, and 5 years ago. So we need to test these alignments, scenario testing, and there are lots of tools available, including Entelligent tool, that have capacity to do that. So I would say, and I know I was seeing a lot of people disagreeing with me on the ruling the data aspect. And I would say that when I say ruling the data aspect, today we are living in an era of climate urgency. And in my past life, I was a professor. Give me a data set, I can find 20 problems with it. Is there a perfect solution? No. But here we all are sitting together and nerding together to build a perfect solution. And we need collaboration from everybody to build that solution. So we cannot just wait for a perfect solution to appear. We have to collaborate, build it together, test it together. And I'm very happy that SEC in US today have a roadmap toward net zero released. EU taxonomy and UK have already done that. So if your model works, it gives you climate results. There are a lot of testing parameters to verify that.
And Pooja, I'm sorry, it answers the question. Yes, investors are looking at progress made in addition to results. So we've got 1 minute left. 30 seconds from each of you. We'll start with Amberjae, then go to Jared, then Pooja. What is the most exciting thing, or what can move the needle the most, do you think, in the next, say 2 years in terms of evaluation of net zero? Amberjae.
Pooja said it best, like we have to work together. This is a global problem. It's going to require global collaboration and an interdisciplinary approach to how we think about what we want to measure and how best to measure it, and then test.
Great. Jared, 30 seconds.
Yeah, I'd probably have to say the same thing, that, there's a development of a collaborative environment right now. Mandatory disclosures are definitely coming across a lot of different geographies at the moment. We're going to be living in a very data-rich, information-rich world when it comes to climate change. And that's going to open up all sorts of new possibilities for us to develop new ways of kind of measuring progress and collaborating across our institutions, whether we're financial institutions or corporates.
Great. And Pooja, last word.
There should be no last man left behind. Every dirty sector, every clean sector, every green country, dirty country should be a part of it, should be responsible to it. A little change will multiply. It's an exponential movement towards net zero.
Okay.
100%. Woo! Nicely said.
I think we're out. So I think you guys are moving on to something else exciting. It was great to have such an interactive, I'm sorry I didn't get to all of your questions, but such an interactive audience, and let's go solve this together. I think we're done.
Thanks, Suze.
Okay.
Suze, wonderful. Wonderful.
Yeah, thank you, Suze. What a great moderator.
No, it was really fun. Thanks for having. Thank you guys for doing such a fun and letting me just run with it. Yeah. Bye.
You're the best. We need to get like coffee, even though we don't live in the same state. We'll figure it out.
I need a note hour with you.
Absolutely. Absolutely.
Bye.
Bye.